Ever since rates spiked and went parabolic in 2022, I've been getting this question all the time, and that's, John, should I pay points to buy down my mortgage rate? You know, it's a big question to answer because it can be a very expensive one. And here's the thing, many people hear the word points, but they don't even really know what it means, or more importantly, how much it costs them. You know, when I say 1 point, actually it doesn't sound like much. But when I say $5,000 on a $500,000 loan, it kind of lands a little differently. So today we're going to dive into helping you answer that question. Is paying points a smart financial move, or are you just giving your money away? I'm going to show you how to think about it. You know, paying points is a complete gamble, and I'm going to give you the simple math to decide if that's a bet you should take. All right, first up, what exactly are these points? You know, it's a term that simply means upfront money paid to the lender at closing in exchange for a better interest rate. You know, it's pretty straightforward. 1 point equals 1% of your loan amount. So if you're getting a $500,000 loan, 1 point is $5,000 out of your pocket at closing. And 2 points, well, that'd be $10,000. Now, points are not always easy round numbers like that, 1 or 2 points. A lender could easily charge you 1.379 points, which in this case would be almost $7,000. You're basically giving that lender a chunk of cash now, and in return, they're gonna give you a lower interest rate on that loan, which lowers the monthly payment and saves you money over time. But that's the big question. When will it actually start saving you money? Okay, let's talk about this like a casino game. You know, they often say the house usually wins, right? But not always. But they certainly seem to have the advantage. You know, throughout my life, if I go gambling, I rarely leave with more money than I came with. But I've certainly had some nights with some impressive wins. Now, in this mortgage game, the bank is the casino, and you're the one at the table just playing the game and trying to win. The day you close your loan and you decide to pay points, if we're at that gambling table, that's like you going all in. You take your big stack of chips, whether it's 5,000, 10,000, whatever it is, and you're just gonna slide that right over to the bank. It's theirs now. From that day forward, they get to keep all of that money. Now in return, the bank says thanks. Because you did that, your interest rate is lower, so your monthly payment's a little bit less. And then each month, the bank is gonna slide 1 chip, which represents your monthly savings, back to your side of the table. And then you sit there month after month, getting 1 chip back. And eventually, if you keep that loan long enough, you'll get all your chips back. Now that right there is what we call your break-even point. And it's only after that point, when the bank keeps giving you more money because you still have the loan, you keep making payments, and each month they give you more money back, more savings, that's when you actually start winning. And that's when you're truly saving money. But what if, in 2 years, interest rates drop significantly and you refinance? You know, I had a client pay $18,000 in points in 2010 to get a rate that started with a 4. And 2 years later, we were offering no-cost refinances at 3.75%. Now, to use that same example, let's say they went ahead and they bought points and they went all in. And they only kept that loan for 2 years, so they got half their money back. And at that moment, when they refinance, the bank keeps whatever's left. That is their money. That is actually the risk in this entire story. Now I'm just curious, have you ever paid points and then refinanced and sold sooner than you expected? Let me know in the comments. So how do you figure out if this gamble is likely to pay off for you? You know, first you need to calculate that break-even point. And that math's actually pretty simple. So here's the main formula that I use. Let's say paying 1 point, that's 1% of your loan amount, reduces your interest rate by 0.5% for the year. You just take that 1%, that's the cost, and then you divide your annual rate savings, or the 0.5%, into that. And that math's pretty simple, right? 1 divided by 0.5 is 2. Your break-even point in that scenario is 2 years. Now you need to keep that loan for at least 2 years just to get your points money back. Now what if that same 1 point only wound up giving you a 0.25% rate reduction? Well, 1% divided by 1/4 is 4 years. Now your break-even is much further out. You see how that gamble changes, but you can figure it out just by doing simple math. Knowing this number, that break-even period, is everything in this discussion. Okay, you've got your break-even number now. Now here are the questions you need to ask before placing that bet. How long will I realistically keep this exact loan? Now forget best case scenarios, right? Life happens. But if you're likely to sell or refinance before that break-even period we just calculated, paying points is probably a losing bet for you. All All right, here's a quick pop quiz. What do you think the average lifespan of a 30-year mortgage is before it gets refinanced or sold? And here's a hint, it's a lot less than 30 years. I'll put the answer down in the pinned comments. Now, the next question is, what is the outlook for interest rates? And I'll tell you, even the experts get this wrong constantly. You know, if you think rates might drop significantly in the near future before your break-even period, well, paying points again might not be the best move. And here's another one. Is there a better use for that cash? Could that $5,000 or $10,000 in points be working harder for you in something else like an investment or paying off high interest rate debt or even just funding your emergency fund or a kid's 529 plan, right? It's called opportunity cost. What else could that money be earning? And is that going to be greater than whatever the savings is that we're talking about here? You might be thinking, John, if it's such a gamble, why are lenders and ads always pushing rates with points these days? You know, there's two main reasons. And real quick, one is that those super low advertised rates with points, well, they grab your attention and they get more clicks and phone calls. It's just marketing 101. And second, the mortgage bond market isn't paying lenders historical premiums, meaning reduced revenue or profit per loan. And then you add increasing costs like loan level price adjustments, which we'll discuss in our next segment. And paying points, sometimes it's not even an option. Sometimes it's a requirement for the makeup, your credit profile, your down payment, the property you're buying. Put all that stuff together, sometimes points are a requirement and not even an option. Now, showing excessive points, it's not always a deliberate trick, but it's a system where you absolutely need to understand if it benefits you before taking that rate and cost structure that you're being offered. So should you pay points? As you can see, there's no one-size-fits-all answer. It's your money, it's your gamble, it's your life. And you're getting this mortgage at some point in time when rates are what they are and future rate forecasts are what they are. And they are all going to be different. The key is understanding the break-even point, being honest about how long you're likely to keep that loan, and then make a decision that best fits your financial picture. I will say you shouldn't have to wrestle with these big decisions alone. People like us do this all day. We'll help you crunch the numbers and figure out what's likely your best bet. Now, if you're curious about the deep dive, like why the points discussion has been a big one since 2022, but not really at all the prior 20 years, or how those weird loan level price adjustments can mess with your rate and cause some of those high point charges, I'm actually breaking all of that down in part 2 of this points discussion. So be sure to click or tap the screen at the end. I hope this gambling analogy helped you better understand paying points. Now, if you can, drop a comment below. I'm curious, what's your personal break-even magic number for paying points? Is it 2 years, 5 years, never? And if you're in my neck of the woods, Washington, D.C., Maryland, or Virginia, and you want to run through some of these numbers for your specific situation, you know where to find me at downsmortgagegroup.com. Otherwise, thanks for watching, and I'll see you in the next video.